crisis and fiscal stimulus lapses. That's according to Fitch Solutions. Now, senior country risk analyst Michael Langham said that while new aid was announced under the 165.5 billion peso Bayanihan 2 law, the delays in distributing those funds could be an issue. Fitch Solutions has earlier downgraded its outlook for the domestic economy to a 9.1% contraction from its initial contraction forecast of 2%. The updated reading is also worse than the government's outlook of negative 4.5 to negative 6.5% for full year 2020. Langham also pointed to lockdown measures, which he said could be a continued problem for authorities. The economy was further reopened in June when Metro Manila shifted to a less strict general community quarantine, but the capital and nearby places were reverted to a stricter modified ECQ from August 4 to August 18 when the caseload rose to over 200,000. Metro Manila was subsequently placed under a GCQ scheme. And there will be no easing of quarantine restrictions in NCR anytime soon, as President Duterte approved the IATF's recommendation for the region to remain under GCQ for the entire October. Lanao del Sur, including Marawi, will be placed under MECQ over rising infections. Okay, Dan, another month in quarantine. Not much to be excited about today, is there? But there seems to be light at the end of the tunnel when it comes to a Bloomberg chart you've got there for us. Tell us more.
Okay, Jess, well, like you mentioned, parang sanay na tayo is with GCQ forever here, so nothing really surprising, nothing too exciting. But this chart might show some positivity for our viewers. You can see on my screens here, these are the new virus cases since the month of February, where we really felt the coronavirus cases hit here. And as you can see on the terminal, August, despite the fact that we reverted back to a stricter lockdown in MECQ again, diba, for half of the month really, is actually seeing the most new virus cases, whereas September, wherein we were back into a GCQ, actually sees our cases decline. So maybe and hopefully this starts, the downtrend there, but of course it's anyone's guess. But at least a little bit of positivity there, that despite the fact that we were in a softer lockdown in September, we did see just a little over 80,000 new cases. Now, Jess, I want to take a quick step back and take a quick peek at our local currency and how that has reacted amid all of this news that we will be seeing another month, at least in the capital, of lockdown measures. You can see us strengthening a touch, actually. That's at 48.465 to the greenback. Not too much movement there. Nevertheless, that did also move in tandem with the oil prices, actually, which had also pared back some gains. That is trading at $40.29 per barrel. Let's take a quick step back on how Wall Street performed overnight. You can see that extending their gains from Friday. Friday saw a pretty good recovery for a lot of shares over in Wall Street. You can see the Dow Jones inching up by 1.5%, the S&P 500 up by 1.6%, and the Nasdaq up by a hefty 1.9%. So what actually happened over in the US? Recall there was a sell-off of all of these major banks, particularly HSBC, even in Hong Kong, as that FinCEN leak happened. And in fact, these were the ones that staged a recovery yesterday. Banks were the ones leading the S&P 500 index to its biggest gain in 2 weeks. And that was after, of course, it fell to its lowest level since July last week. In fact, HSBC, one of the most sold off, placed almost or added almost 9%. That's as the biggest shareholder started buying back in to its own company. Another thing that's happening over in the US fiscal stimulus talks are ongoing right now. Everyone is looking what's going to be happening before the November election. Recall that there's going to be the first presidential debate today over in the US between Biden and President Trump. And also, markets are awaiting the employment report on Friday, seeing how the U.S. is transitioning in this COVID-19 pandemic is going to be coloring a lot of how we will be trading over here. I'm hearing a bit of an echo here, but let's try and see whether we can actually take that out. Now, shares in Europe, as you can see in my terminal here, did rise the most in 3 months. So that's a lot of positivity there. But if you take up a quick peek on Asia, it's a bit of a mixed picture, but mainly towards the upside, except for Japan. So Japan seems to be sitting out this rally, but if you take a quick peek at the Hang Seng, that's up by 0.14%, and the rest of the markets also enjoying several gains. Another thing to be watching out for today is China. I mean tomorrow. That's as their purchasing manager index is out. They're expected to show a September manufacturing print, which has improved slightly, but non-manufacturing may have moderated or gone down from August's level. Now, let's take a quick peek at our own index and how we are performing compared to the rest of the region. Not necessarily in step. You can see us at 5859.31. That is down a touch by 0.04%. And this comes after we had already recovered yesterday. We were up by 0.4%, albeit still with very, very thin trades at just over 5 billion pesos. Now, Triple A's Chris Mangon had predicted this already. We will be moving sideways. But of course, this rally came after the GCQ announcement. And so this is the market's opening, waking up to this GCQ announcement. It doesn't seem to be such a nice reception. This comes after also we saw net foreign selling ballooning to 1.8 billion pesos. That's the most we've seen in 7 weeks. Now, I just want to take a quick peek at our sectors here and whether there are some bright spots. We're going to be watching a lot of the consumption stocks, a lot of the airline stocks, malls as well, especially with this prolonged GCQ. You can see a very mixed bag here. Industrials leading the charge at 0.5%, properties and financials, but holding firms, services, which also take into account a lot of our restaurants, for example, like Jollibee's under the services counter, that is down by 0.4%. I just want to take a quick peek at our airlines here. I had mentioned that earlier that it's one sector that I want to be watching out for. This after we've received also news that the Philippine air traffic might remain below pre-pandemic levels even in 2021. That is according to Fitch. They're saying that the risk still remains very high here. They're comparing us to Indonesia, and international traffic volumes will be even weaker than what we've seen domestically. They say that the Philippines and Indonesia will be seeing revenue passenger kilometers at just 35% of the normal levels this year, and next year just 60%. So no real recovery to normal levels even in 2021. They did say, though, this assumes no vaccine yet. So perhaps there's still some upside there. Now, China seems to be, for Fitch, the only country expected to recover in terms of air traffic. Vietnam, they say, might rebound even faster. But Singapore might be seeing a 70% drop in passengers this year and 50% below 2019 levels, even as far as next year. So not a pretty picture here. Cebu Pacific opening down by 1.8%. I also just want to take a quick peek at the property space, particularly Cebu Land Masters. We've had some good news when it comes to the property sector as of late, especially after that report from the Bangko Sentral saying that residential sales were actually going up in the second quarter despite the pandemic. And take a look at Cebu Land Masters, up by 0.8%. They have just announced that they've finished 3 tower condos in CDO, that's Cagayan de Oro, that was worth 1.2 billion pesos, and they've turned over more than half, and they expect around 2 billion gross revenues in that. Recall that also they saw a record reservation sales of 41% growth in the first semester of 2020, even as the net profit is falling. Now, just one thing that I wanted to look at, especially since we're already at the property sector, and you can see that on my screen, is the construction space. The BCDA has started soliciting bids for the connector road from MacArthur Highway to New Clark City Airport Road. That bidding is restricted to Filipinos or only 60% Philippine-owned enterprises. So a lot of things going on, especially for the property space and construction today, Jess.
All right, so from bidding for roads to actually would-be investors or stakeholders, this time around for the Malampaya stakes getting hotter by the day. What's the latest there, Dan?
Okay, so we're going to be seeing a lot of bidding war is possibly going on here for the Malampaya stake. What is that Malampaya stake? It's the only natural gas field here in the country. It's in the West Philippine Sea. And of course, there's a lot of issues on the contract there because the current contract is until 2024. And then there's a question on what's going to be happening after Shell had disclosed to divest 45% of their stake. That's called the Service Contract 38. Now, what is going on here? Chevron had divested last year the 45% stake, and they had sold that over to Udenna Corporation, which is run by Dennis Uy, who also owns Phoenix Petroleum. And now, Udenna is saying that they would like to have the control of the full Malampaya project. So 45% plus another 45% would be 90%. The rest would be still with PNOC's EC, so that's 10%. They say that they are the logical choice to ensure a smooth transition. This comes after Ramon Ang of San Miguel and MVP, who of course owns PXP Energy, which also has some projects over in Recto, but still those are not operational because there's a lot of disputes going on still in the West Philippine Sea. So not operational, have seeked interest already or expressed interest in that Malampaya stake that is being sold by Shell. Dennis Uy's Udenna is claiming they actually have preemptive and consent rights. So they might actually have the first say if this sale does push through. So a lot to be watching out for there when it comes to Malampaya. Now, moving on, just to your end of the speed desk, to some developments for would-be foreign investors, especially when we talk about the retail space. So there might be a chance it's going to be easier for these foreigners to finally come here to the Philippines and set up shop. What's going on?
All right, so at least, well, it's not entirely like everything's already set for them, but at least one piece of the puzzle has already been solved, or at least been hurdled. This after Senate Bill number 1840 has already passed a Senate Committee on Trade. So basically, this measure amends the Retail Trade Liberalization Act of 2000. So just to give you an idea, basically the premise of this measure is that it eases rules for foreign investors to actually enter the local retail sector. So let's try to take a look at what exact amendments is this measure pushing for. For one, it's actually going to reduce minimum paid up capital for would-be foreign investors to $300,000. So that's actually quite a downgrade here. That's coming from currently minimum paid up capital for investors is set at $7.5 million with investments in each store already at 830,000 US dollars. Now, these amendments that's being pushed for at least is going to only require $150,000 investment at least per store. At the same time, what's interesting here is that currently the RTLA or the Retail Trade Liberalization Act requires enterprises with $2.5 million to $7.5 million to be wholly owned by foreigners except for the first 2 years. Now, with the current changes here that's being pushed for in Congress, it already removes the capital requirement, at least for high-end stores and those luxury stores as well. It also does away with a requirement for these investors to actually have a 5-year record in retail. It also removes that requirement of 5 retailing branches at least. Also in the new bill, only foreign retailers whose country of origin allows entry to Filipino retailers will be covered by the new measure should it pass Congress. Of course, it goes without saying, you have the Trade Department backing really the measure to boost foreign investments. FDI in 2019, if you recall, has fallen 23% to $7.6 billion. And Trade Secretary Mon Lopez in yesterday's hearing for the budget of the Trade Department said that it's primarily, the drop in FDI is primarily due to stiff competition in the region. He admits that there are locators from China who opted to go elsewhere in the region, short of saying, that the Philippines really is not a first choice for this locator. So another concern as well for that the drop in FDI are pending structural reforms that includes amendments for the Retail Trade Act as well as the Public Service Act. There are also, of course, concerns over the tax reform programs, especially those under CREATE. Now, the House already passed their counterpart measure back in March, but that in fact has even more drastic reductions here for foreign investors. They're reducing minimum paid up capital. They're slashing it to $200,000 compared to the Senate version, which slashes minimum paid up capital to $300,000.
Jess, I mean, this has been, something of contention because on the one hand, it's good to encourage foreign investments to come in, but on the other hand, it does affect the small local businesses. Diba? And there are all these movements support local, lalo na in this quarantine period, and ang hirap-hirap na nga ng local businesses. So what's their say in this? Are they actually supporting this bill?
I mean, I think it would be a given, at least for local retailers, to be up in arms over the measure. But somehow they are at least agreeing to some level of compromise here. In fact, they're saying, at least lawmakers can actually reduce the minimum paid up capital to $1 million compared to the current $2.5 million. But going beyond that, they say might be actually too drastic here. According to them, let's not expose the small businesses to unfair competition just because the authorities want substantial financial investment from foreigners who in turn will actually benefit from the local market base. According to the Philippine Retailers Association, particularly their Vice Chairman Roberto Claudio, the government should actually seek financial investments, not market disruptors. But it's basically this that actually pushes the European Chamber of Commerce in the Philippines to actually also support the measure. According to them, it's time to stir healthy competition in retail, which is good for Filipino consumers, especially for the growing middle class, who can purchase a broader variety of goods at lower cost. According to them as well, to the ECCP, our Asian peers have less restrictive business environment for foreign retailers. They are backing the measure, but prefers the House version. But according to them, at least, the Senate version still is a step in the right direction. So let's see. This is a priority measure. Let's see how it's going to fare in the upper house and how the Congress, the lower house, and the Senate are going to work their differences out.
And especially just since this naman, encourages more employment as well. So even if they are foreign companies, it's still employment for the Filipino people. Thanks for that update, Jess.
Now, here are other headlines we're keeping our eyes on. President Rodrigo Duterte is now hitting Facebook for taking down social media pages linked to security forces. Philippine Star reports that the president even threatened to stop the tech giant's operations in the country during a televised speech on Monday. Last week, Facebook took down at least 100 accounts and pages, some of which were linked to the Philippine military and police for, quote, coordinated inauthentic behavior. Facebook found that a network operating in the Philippines relied on connected clusters of fake accounts to evade enforcement and post content mainly about military activities against terrorism and criticisms against communism, youth activism, and opposition, among others. Authorities previously proposed to use social media channels to monitor activities in violation of quarantine protocols. Meanwhile, Duterte said in his state speech that Facebook has opened a Pandora's box and has encouraged advocacies of leftist movements after taking down government social media pages.
Facebook, listen to me. We allow you to operate here, hoping that you could help us also. Now, if government cannot espouse or advocate something which is good for the good of the people, then what is your purpose here in my country? So, kung hindi tayo magkaintindihan dyan, mag-usap tayo uli. Is there life after Facebook? I don't know. Pero, mag-usap tayo.
Now, off the other stories we're keeping our eyes on, Marikina Representative Stella Kimbo expressed support for measures providing more support for MSMEs affected by the pandemic. In a plenary session, the proposed 2021 budget, the minority legislator said the country can minimize job losses by providing credit access to struggling or closed small businesses. Kimbo noted that the country must take advantage of its credit rating to borrow funds for stimulus programs supporting businesses. Back in July, Moody's Investor Service affirmed the Philippines' Baa2 credit rating with a stable outlook. A United Nations survey showed that despite the easing of quarantine measures, most MSMEs still have limited operations while others remain closed due to lack of funds, mobility issues, and weak consumer demand. The United Nations Development Program reported that 49% of the 285 MSMEs surveyed remain closed, while 38% are at a reduced capacity in June to July. The UNDP noted that most affected businesses were those in the accommodation sector. After all, MSMEs surveyed in the industry reported declines in average monthly earnings.
Now, moving over to Korea, Big Hit Entertainment is looking to light it up like a dynamite. Pricing its IPO at the high end of its range, shares are priced at 135,000 won a piece. Bloomberg reports that the management group behind K-pop group BTS will be raising about 960 billion won, that's around $820 million from its initial public offering. Big Hit's IPO will be South Korea's largest in 3 years, reflecting the growing success and popularity of BTS in the global scene. Some analysts agree that the timing is right for Big Hit to go public with album sales going up amid the pandemic, and BTS fans dubbed ARMY, proving to be a hot commodity for investors. BTS also grossed $170 million last year, landing it a fifth spot among the world's top concert draws. The stock's trading debut in the Korea Exchange is expected on October 15th, while retail investors will be able to subscribe for shares early next month. Now, Metro Manila remains under a soft lockdown for yet another month, with around 90,000 businesses still closed. How will market sentiment fare today as the economy takes another blow? Here to share with us his insights, we have Philstocks' Japhet Tantiangco. Good morning, Japhet, and welcome back.
Good morning, Ma'am Danie. My pleasure to be here.
General sentiment on the GCQ story. I mean, were markets already pricing that in? We saw that we opened with some losses here. Why? Were we actually hoping for anything better? Is this not something that's good for the economy long term, especially since we still have rising COVID cases, and at least we were not reverted back to stricter restrictions, and it still allows the economy to move forward? Or was there a bit of a sour sentiment when it comes to the markets?
Well, with respect to, for the most part, we're still in status quo. Metro Manila is still in a GCQ, and I believe this is something that investors have already priced in. That's why if you're going to look at the value turnover of the market, it remains tepid. Net value turnover for September is averaging only 4.6 billion per day, which is below the
Mm.
year-to-date average of 5.8 billion. So we have tepid value turnover here, representing the lack of confidence on the part of the investors. And again, this is because of the GCQ that we are in. Of course, this is preferable compared to the more stringent quarantine measures. But then again, under GCQ, we still have restrictions that are keeping our economy from operating at full capacity. And given these restrictions, the economy is expected to to have a hard time in terms of recovery, and that's why investors are reacting as such.
Japheth, let's talk about the thin trading volumes, which you've already mentioned. Is that because of the foreigners, the net foreign selling that is going on? Because it seems, I mean, in some reports, the retail trades during the lockdown period actually increased, diba? Because more people are actually at home trading, etc. There are even smaller issuances that are now getting a lot of attention. Why the thin trades still are, and also given the fact that the caution, the the earnings have been digested. Things are already not necessarily clearer, but at least, moving forward, the policy seems to be clearer in terms of monetary policy, in terms of the budget being already approved, the fiscal spending there as well. So what's going on? Why is it still tepid?
Well, if you're going to look at it, value turnover, again, it represents the poor confidence towards our local equity market right now. You mentioned a while ago about net foreign transactions. Well, net foreign
Mm-hmm.
selling is already on a 12-day streak, averaging 693 million per day. So on that alone, it already reflects how foreign investors are pessimistic towards us. You're going to look at the net value turnover, which is on the which represents the retailers, the retail investors, and as mentioned a while ago, it's only at 4.6 billion, averaging 4.6 billion for the month of September. So it's also anemic. Overall, it's about poor confidence, and this is still
Mm-hmm.
because of the uncertainties with respect to the outlook of the economy. I mean, yes, as you've mentioned, our monetary policy is already clear, and it looks like the on the upcoming meeting, the BSP is going to keep rates unchanged, meaning to say,
Mm-hmm.
monetary policy will remain supportive, and at the same time, the government is still aggressive with its spending. But then again, overall, what investors would want to see is how the government would be able to contain the virus, to
Okay.
manage the COVID-19. As the faster that we will be able to control this, the faster that we will be able to ease restrictions, the faster that we do that, the faster that the economy recovers, and that's what investors are looking into.
What are you pricing in when we talk about third quarter earnings? Is there enough, information, at least in the past few months already, to be giving a positive or optimistic outlook on the third quarter compared to the first two quarters? Or have you changed course and say, okay, this difficulty, these setbacks in the bottom line of companies will actually be persisting?
We will still see we'll still see persistent, the way we see it, the weakness will still be seen on third quarter earnings, but it looks like that the worst for corporate earnings has already been in the second quarter, wherein we have the prolonged stringent quarantine measures. For the third quarter, given the easing of restrictions, we may see more economic we've seen more economic activities, and in connection to that, we've also seen a lot of corporate activities. So there could be some recovery quarter on quarter. Speaking quarter on quarter, there could be some recovery in earnings. But if you're going to do it on a year on year comparison, of course, the expectation is it would still be below last year's third quarter, given the persisting economic weakness that we have.
Okay, but still, at least worst is over, and second quarter may have been the
Yes.
worst. In that case, is it time to be picking up the oversold stocks? Especially now that it's going to be GCQ again another month. What's your sentiment on the retailers? The food stocks like Jollibee seems to have it's the best performer right now. What's your take on restaurants, on malls, on airlines, these sort of stocks? If you think that the second quarter was already the worst hit.
Well, moving forward, we still have to be picky, or we still have to choose wisely which sectors we're going to look into, or which sectors are we going to invest. By the end of the day, the economy is moving towards a new normal, and we're seeing a restructuring in the economy. So those which will be able to adjust to the said new normal are the ones that the ones that we can look into. Going into restaurants, the likes of Jollibee, of course, we are expecting that the quarantine measures that we currently have is going to stay longer, and with that, these restaurants are going to operate still below full capacity in terms of dine in. So for those who would be able to tap or to strengthen their other channels, the likes of deliveries
Mhm.
and takeouts, what Jollibee is doing right now with its strategy. Those are the stocks that we can look into. As for food, of course they remain as one of the important ones, the necessities of the consumers. So the retailers, the likes of Pure
Mm.
Gold, there's still good picks for us. And you can also look into the foods, the likes of URC. So and finally, for the airlines, the airlines is the ones that we are not really optimistic with, and we are pessimistic with this one,
Okay.
given first, there's still the COVID-19 risk, so not many people are still willing to travel in order to avoid that risk. At the same time, the economy has weakened. There's not much disposable income right now in the hands of the households, so there won't be much incentive to travel. And given that, it's going to have a negative impact on our airlines. It's expected to operate below pre-pandemic levels, even come the succeeding year. And so we expect their financials to remain pressured. So we're avoiding the airline stocks for now.
All
Okay.
right, Javed, let me just quickly jump in here and Jess over here. One other question, let's focus in on one particular stock here. This, after, of course, Udenna this time already expressed interest that they want further control of the Malampaya gas field, saying that they are the logical choice primarily. How do you think might this actually affect their share price? How are investors going to price this in, especially considering as well, you have other interested parties here, the likes of San Miguel and even PXP?
Well, for Udenna Corporation, what they're doing right now, they're aggressively expanding. It's a strategic acquisition. To take well, of course, that's with PNOC to take the another 45% in the Malampaya. Take note that Udenna has been aggressively expanding. Previously, it's been into the telecommunications. It's also went into gaming. So you have a lot of investments there. Our only worry is that it's been aggressively expanding in a short period of time. So we may have to look into how they're doing these stake acquisitions. And another thing that we will have to worry about there is it's estimated that Malampaya is expected to be depleted by 2027. So
Mm.
they are running on, time is not unlimited on this one. And that's one of the things that they should be worrying about. As for the other ones who are planning to take a stake on Malampaya, the likes of San Miguel and
Mhm.
Manny Pangalinan's group, it's going to be a threat to them, given that as Udenna Corporation or UC Malampaya said, they have seemingly have the rights or the power over this one. So it's like, they will be the first ones to be considered in terms of this acquisition.
Okay, so something to be watching out for there. But as you mentioned, it seems to be tilted in favor of the Dennis Uy stake there. Thank you so much for those insights. That was Japhet Tantiangco of Philstocks.
You're very much welcome.
And that's a first look into the business day. Today is Tuesday, September 29. I'm Danie Laurel.
Catch us again tomorrow at 10 a.m. I'm Jess De Los Santos. We are One News.